Afternoon, everyone. Welcome to the Healthy Campus Financial Wellness 101. We're excited to have such a great turnout, especially on Zoom. Hi, everyone. That's right, crazy, but you all can see me. I'm Julie Chaupy, the Associate Director of Health and Wellbeing Programs with the WorkWell Center. And we're really excited to have all of you here with us today. I'd like to introduce our co-lead for the Healthy Campus Financial Wellness Subcommittee, Dr. Jana Wong.
Well, thank you. It's actually just Professor Wong.
Professor Wong.
I co-chair the Financial Wellness Subcommittee with my colleague, Peter Carden. We're both professors in the Marshall School of Business, so it made perfect sense to us to jump onto this committee. We believe that financial wellness is a significant part of one's overall well-being. Finances can cause stress, but they can give others financial freedom. Early in the life of USC Healthy Campus, the advisory committee sent out a poll, and financial wellness landed in the top 5 of topics that faculty and staff are interested in. Financial wellness is important for one's overall sense of well-being, and we are so happy that the university is supporting not just this committee, but all of them that support overall good health. Our goals for this committee are to educate and help our faculty and staff understand the fundamentals of personal finance. To that end, we are working on a glossary of terms that will soon pop up on the Healthy Campus website, and we plan to schedule articles for the website and lectures from experts in the field. So this is how our very first webinar came to be. We are extremely excited to be welcoming Ryan McDonald, the Director of Business Development at the USC Credit Union, who will be presenting Financial Wellness 101, Budgeting and Debt Management. So thank you for all being here, and I'm going to turn this back over to Julie.
Great, thank you so much, Jana. And just a reminder for all of you to stand up and stretch. You're welcome to move, stand and stretch anytime during today's sessions. I just wanted to make that announcement. And with that, it is my honor to introduce our speaker, Ryan McDonald, Director of Business Development.
Thank you very much.
Turn on market.
Welcome, everybody. My name is Ryan McDonald here from the USC Credit Union, and we're
That better too.
Information in regards to budgeting and debt management today. Fantastic. So today's agenda, we're going to look at the current economic environment, where we currently stand right now, because there's a lot of information currently to update everybody on. We want to focus on really understanding why we should have a budget in regards to some budgeting plans, specifically budgeting for savings. Really want to talk about debt management and how we work throughout debt there. And we're also going to speak about credit cards, because a lot of the debt that is first built and established is on credit cards themselves. I'll share some great financial wellness resources that we have here at the USC Credit Union for you, and then we'll take questions at the end. So by all means, add your questions in the chat, but we'll be getting to those at the end of the presentation. So jumping into it right away here for everybody, our current economic environment and where we currently stand right now. Inflation is a very large topic on everybody's mind. Some great news, but I don't think we've truly all felt this directly in our own pocketbooks and seen that out in regards to prices there. But inflation has been dropping from a 40-year high in June of 2022 to now basically coming up around 3.2%. So we've had some, so there we go. We're just adjusting our sound here. So inflation has come back in regards to a much more manageable indicator there in regards to our consumer price index. So it's really great to see that that's coming back in line. Probably still, waiting to feel it in my own pocketbook, but the key is that number has been coming down from that.
So keen to convince us.
In regards to our interest rate trends right now, primarily the prime interest rate is something that we all want to take notice of, because that is the key fundamental driver in regards to where rates going to be going. And in regards to our latest update that we just had this month, is the prime rate stayed where it currently is at 8.5%, which is a great sign. We have a lot of forecasts indicating that that prime rate will be coming down by the end of the year, possibly 1 percentage point, but it will be very slowly over the next couple months towards the end of the year. So forecasting saying that we'll probably go from a rate of about 8.5 to about 7.5, which is something we'll all see truly reflected in our pocketbooks in regards to that interest rate savings there. Where we're currently seeing savings in regards to high yield rates right now, really want to take advantage of the marketplace because we have had those savings rates dramatically increase over the last year. Primarily we're seeing this in our CDs. Those are our cash deposit rates in which you're locking those funds up for a specific term. We're seeing those as high as 5% right now compared to your typical normal savings accounts that are still paying, very little, basically under probably 2% right now. So take note of where your funds are in regards to those savings interest rates and truly look to see what you can do to increase that. As I suggest right now, CD is a great place if you're not utilizing any funds. You can lock that up in a term ranging anywhere between 3 to 1 year right now. And specifically, we're seeing a lot of high interest rates right now in that 5% range. So great time to make sure that your savings is working for you. In regards to our consumer loan trends right now, we're really just seeing this continued steady boat right now in regards to rates, as primarily everything is kind of based and reflected off of that prime interest rate. So once we start seeing prime coming down, we'll start seeing some flexibility in those consumer loan rates. But typically right now in regards to your personal loans, you're probably seeing, a starting rate of about 10%. Car loans right now are still a little bit high, but hopefully those will be coming down as we see some adjustments in our prime rate. And most importantly here, mortgage rates, always a very popular topic, and people want a lot of insight in regards to where those rates are. We've truly come out of a historically low interest rate period on the mortgage side. A lot of us have got used to that and thought that these were normalized rates. Unfortunately, this is something that we probably won't see again, possibly in our lifetime, is those rates were extremely low. And we're now hovering around basically 6.5 to 6% in regards to our mortgage rates this year. By the end of the year, forecasts say we'll probably still just be above 6%. And that truly is a normal interest rate for a mortgage out there. What we were seeing in years past in regards to 3% was just a response to the economy there to get that up and running, and we likely won't see that again. So there's a great insight in regards to where we are in our current economical review there in our forecast. And now jumping into some of our great topics here in regards to budgeting and debt management. So first off, to get us started, I want to just focus on why we should all have a budget. It's extremely important here because it's going to provide us direction of where we need to locate and utilize our funds. It's going to really educate us across the board. Most importantly, it's going to reveal waste in regards to where that money is going, because I think already this morning I've used a debit card, credit card, and cash, and I have no idea how much money I'll spend. So we really need to make sure where those funds are going. And most importantly, a budget is going to create new habits across the board. And with creating new habits, most importantly here, it's going to reduce our stress. And that's the whole focus of being in control of our finances, having a budget, truly having a plan that's going to get us from the beginning of the month to the end of the month, from the beginning of the year and to the end of the year. So really important that we stress that everybody should have a budget. And this is always that something is you're continually reviewing, continually working on. It's not a one and done. I'm into my budget, at the beginning of the month and pretty much every weekend reviewing my budget during the month and then at the end of the month. So I'm always in basically budgeting mode myself. So what we want to look at when we start looking at our budget, how to put that together, we want to determine our income right off the bat. So we want to know kind of what our payment schedule is. Are we being paid weekly? Are we paying bi-weekly or monthly? We can determine that payment frequency and then specifically what that income is going to be. In regards to bi-weekly budgeting, I really like this one because on a bi-weekly payment cycle, basically you're getting paid 2 extra paychecks during the year. So you can utilize that for other items. When I'm being paid bi-weekly, I just count on 2 bi-weekly checks coming in, but there's going to be 2 additional months during that year where you're going to get a third one. So you can utilize that for some budgeting, which is really helpful. So all that money comes into your account basically, or I should say on your paycheck, that's your gross income. That's your total amount before taxes and deductions. And right now, while we're looking at kind of tax season and those deadlines coming up, it's really great to kind of review your paycheck and determine to make sure that your withholding taxes for the IRS and the state are all set correctly so that you're not in an owing position at the end of tax time. So I always just go through my accountant and make sure, have them review my paycheck, making sure that I have the correct deductions for the IRS and the state they're coming off. And that money left over is basically my net income. That's the money that I'm having direct deposited into my bank accounts. And then from there, that's my discretionary income, and making sure that after I paid all my bills, these are all the items that I have in which I can use to achieve my financial goals. So we're moving from our gross income, our net income, making sure all our bills are paid, and then left with our discretionary income in regards to our budget. So in regards to calculating our monthly expenses and what we really want to focus on here, first you want to break down all your categories here. You want to look at housing, utilities, food, transportation, debt payments, savings, personal spending, entertainment, and miscellaneous. There's a ton of categories here, so we really want to have a full breakdown and understanding of where our funds are going. Most importantly here, some additional considerations which we have to factor in here is fixed versus variable expenses. Really important with summer coming up, and this was the first lesson I learned when moving to Southern California here, was my air conditioning bill there. Oh my gosh, it went from basically paying next to nothing during the winter, and then I turned that on and we were looking at several $100s over a couple months there. So really making sure that we're understanding, what those variables can be on a seasonality basis compared to our fixed bills. And in addition to that, another item that came up in my budget the other day were my car tags, and not factoring in annual expenses across the board. So making sure that you're taking note of what those annual expenses will be during your year, and make sure that you're setting up savings for those items in your monthly budget, because you're not thinking about those annual expenses right off the bat. So two huge considerations to note there is those variable expenses based on seasonality. Maybe they're $20 one month, a couple months down the road, those can be, far more expensive, up in regards to the hundreds of dollars there. And then taking note of annual expenses. Another item that came up this weekend for me, in addition to my car tags, was just my vehicle maintenance there. That's something I don't plan on a monthly budget. So have to factor that into my budget there, because that maintenance just comes up once a year for me. So in regards to tracking our spending, it is tough because we're making several purchases a day. We have multiple avenues in which we can utilize that, through cash, through our debit card, through our credit cards and checks. So utilizing all of these options here really complicates the process in regards to tracking our money. So we want to make sure that we're utilizing online banking or any additional budgeting software tools there. Personally, I love Excel. I write everything down in regards to what my money is coming in at the beginning of the month. I break it all down into all different categories, and then kind of know what that discretionary income I have is at the end of the day. But pretty much all the categories that I provide have a full dollar value assigned to it, and basically I'll be looking to most likely spend all those funds in regards to each item that I have assigned there. So making sure that you're equipped is going to really help you adjust your behavior accordingly and be able to track your spending and really have that budget in place. And most importantly today, there's two budgeting plans that I want to review with everybody, and these are my two favorite ones here, which I'm constantly using together here. We have our 50-30-20 plan, and we have our 2-account plan, which I've now famously nicknamed our 3-account plan because of the utilization that we have in Workday, in which we can set up 3 bank accounts to have direct deposit, and can utilize that feature to really help us in regards to budgeting our funds. So jumping into our 2 plans here, our first one is our 50-30-20 plan. This is a great simplistic plan here that's really just giving you an indication of where you need to have those funds focused on. 50% of your needs, all your shelter costs, what do you need to survive on a daily basis here? From there, 30% should be going towards your wants, and most importantly, 20% should be going towards your savings. And that's probably the category that people have squished the most in regards to their savings. So really want to focus on, when you get paid, consider yourself as your own financial institution, your own bank or credit union, and pay yourself first. That's the first thing that I do in regards to when I get my money on a monthly basis, as I'm paid monthly here. and making sure I'm setting aside savings. That's going to go in the form of basically our 401k contribution and some additional savings buckets that we're going to look at. But just going back to our needs category of 50% and noting specifically in Southern California, where we currently are in regards to, renting and housing prices here. The focus most people think is, in regards to a housing payment should be 30% of your total income then. But as we all probably know right off the bat, we're all much higher in regards to rent or our mortgage payments of 30% of our income. So with that, we really need to look to squish that wants category. We're squishing the savings category, but I really want to try to get away from squishing the savings category, make everybody, focused on that 20% putting it away. Because the earlier we start, the better, because that's going to allow us to utilize the time value of money and compound interest here. So great simplistic view to look at your money when it comes in at the beginning of the month in regards to 50% going to all your needs and basically all your bill payments right off the bat, 30% being your discretionary income and your wants, and then focusing that third bucket in regards to savings, and at least focusing on 20% there. Our second budgeting plan that we have here is our 2-account plan, but you working here at USC here and our workday system, I'm going to call it our 3-account plan. And this is how I've specifically set up my budgeting going back to our 50-30-20 plan here. So with the 3 bank accounts that we can set up direct deposit and workday, the first account that I have basically is all of my needs right off the bat there. These are all my fixed term variable bills. They go directly into one account. I know exactly the money that's going in, and all those funds are being spent in order to pay all the bills that I have. The second account that I have direct deposit going to is basically my discretionary income there. From there, utilizing it on the categories that I've noted in my budget. And then the third account that I'm using for direct deposit is my savings account, making sure I have money going directly into a savings account. So I'm setting that aside. So our 2-account plan, really in regards to what we have access to in the resource and workday, I love it now calling it a 3-account plan because you can specifically set, kind of 50% of your income directly for all your bill payments, but obviously we know that's going to be a little bit higher than that. Then we can have that second account set up so it's directly for all our discretionary spending and all those categories that we have. And then our third account, we can make sure that we're setting aside our savings there. So, the 50-30-20 plan really focuses and works in addition to our 2 and our 3-account plan here as well. So great options for you to utilize on a monthly basis and every week during that month so that you have full control over your funds. So really important in regards to sticking to a budget. We want to be realistic. You don't want to just, strive for the moon right off the bat, but I love to do that in regards to setting a plan and then, really focusing on it month by month, making small steps and increments over time. Once you identify basically where that money is going, changing your habits, looking to get rid of that waste, you can be much more realistic in setting some goals here. Really focus on planning ahead. Have that 1-year plan, 3-year plan, 5-year plan, 10-year plan of where you want to be in order to have your budget working with you in regards to that. And most importantly, utilizing credit cards responsibly, as well as, checks, debit cards here. It's very easy to use it very quickly out there during your day making purchases and then totally losing track of how much money that you've spent. So utilize online banking, review your transactions, over the week. Don't just do that right at the end of the month. And then be aware of, oh my gosh, I had no idea last week, I spent a couple $100 compared to the following week where I spent much less. And you really want to get into that continual behavior of knowing where your money is going. So from here, we want to focus on, specifically budgeting for our savings because our environment here is all spend out there in regards to consuming, and we really need to focus directly on our savings. So really there's 3 buckets that we want to focus on here. First one is our emergency savings. That's about 3 to 6 months of saved income. And after coming out of kind of the COVID environment here, most financial advisors have really said, 3 to 6 months isn't enough. You need to focus on having pretty much a year's worth of your income set aside. Well, that's a tremendous feat right there. Even 3 to 6 months for people, you know. Most individuals are living paycheck to paycheck because of our expenses, our housing expenses are so high, you know, so really just trying to focus small amounts at the beginning here, work up to 3 months, work up to 6 months, then look to focus to work up to a year. Our second bucket that I strive to have everybody focus on is a set aside savings for large expenses or any annual expenses that you know are coming up. You know, something that you're just really not focused on, but at least having some money set aside in your monthly budget and going to those annual expenses there is extremely important. So you're not just left at the end of the month going, where is this money that I need and where am I going to find it in my budget? And then most importantly, that we're, you know, focused on our retirement savings. We're making contributions and maxing out our contributions directly to our 401k account. We have a fantastic plan here at USC. So right off the bat, you want to maximize that contribution and make the most of the time value of money and compound interest in regards to your retirement savings. In addition to the 401k plans, you can also make your supplemental and additional contributions through your IRA accounts there, and you have two different types of accounts there. That's a traditional and a Roth account there. Both are going to have different taxable consequences in regards to your traditional. You're taxed once you make that withdrawal, compared to a Roth is there's no taxing at the source because that's done at the beginning there. So in regards to your retirement savings, make sure you're maximizing your 401k contributions. From there, you can make any additional supplemental contribution up to about $6,500 per year to an IRA, being a Roth or a traditional IRA there for yourself. And really looking at, you know, what options you have in regards to savings and what are the different investments that you can make here, all depending on your potential risk and reward. You know, starting off at the very bottom here in regards to full security, you have your regular savings accounts, you have your money market accounts, you have your value plus money market accounts. Take a note, as I said, right now, you know, where your savings is sitting. Typically in those three accounts, you're looking at low interest rates, but it's fully basically secure and it's fully liquid for you to utilize at any time. From there, cash deposits right now, we're seeing a tremendous rise over the last year in those rates. Right now, as I mentioned earlier, you're looking at around 5% in the marketplace in regards to a cash deposit. You're locking that up probably for a term of about 9 months to about 1 year's time. Take note of financial institutions of what their minimum dollar requirement is here. Some of them just have a minimum dollar requirement of $1,000. Some may have it as high up to $100,000. So take note of what that criteria is from banks and credit unions out there and really look to get your money working for you at some of those high rates. In addition to that, working, in the market, you have access to bonds, mutual funds, and stocks. Obviously, within those, your risk and reward is growing in each of those. So you just want to be fully aware and look at the time value horizon that you're looking to focus on for those funds there. But these are the savings options that you have right now. And a really big fan myself of our cash deposits and the cash certificates out there, providing 100% security at a great rate in the marketplace, ranging around 5% right now. So as I noted, take a look at where your savings money is, what interest rate you're receiving, and make sure that you're maximizing that. Because as we start seeing these interest rates come down by the end of the year, we're going to see that reflected in our savings rates. So make sure that you're taking advantage and locking that up. You're not requiring to use them right now in the market. I want to jump into debt management here as we're talking about budgeting. The whole focus of budgeting is making sure that we have money set aside to pay our debts. And basically, we're utilizing that budget to make sure that we're assigning categories for those debts and that we're paying them down. Really important when we're looking at our debt across the board, we're ranking it from the highest interest rate to the lowest interest rate and not actually on the outstanding balances here. We want to focus on paying the highest interest rates first because that's the largest amount of our money and that monthly payment going towards interest. We want to chip that away. We want to focus on that monthly payment and the majority of that monthly payment going to the principal reduction of that debt. And when we're looking at that debt, first off, we always want to make sure that we're making payments on time. so extremely important here in regards to, maintaining, managing, and strengthening our credit. Basically, one 30-day late payment in regards to any loan facility can drop your credit score by up to 100 points. So just one 30-day late payment, drop your credit score 100 points, and it can take you up 2 years of perfect repayment behavior to get that 100 points back. So just, one shot here on late payment of 30 days can really take you, that long time to get that back. So we want to make sure and provide some convenient, factors for us here. So, set up auto payments. So you don't need to think about it. You know that those bills are going to be paid. And the key advantage is just making sure that you have your budgeting in place and that money set aside in those accounts to make those payments. And one of my favorite features is round your payment up in regards to making some of those bills, whether it's just rounding it up to the nearest dollar, the nearest tenth of the dollar, the nearest $100, anything that you can do to increase your principal reduction on that debt, which will make that interest rate payment smaller than so. A couple payments that I have, say, are for $105. I just round that up to $110 or $120. Want to chip away a little bit more than I currently am when I have that budget flexibility there. So really important, we're looking at all of our debt, we're categorizing it in regards to, most importantly, we focus on that outstanding balance. But I want you to focus on the interest rate, noting what the highest interest rate is first, making sure that we're chipping away at that money, and then as well, focusing on next what that outstanding balance is, and then looking at what our options are in regards to debt consolidation. We're going to get into that in just a second, but really what probably one of the most important pieces of information here that I provide our faculty and staff here on campus is how to monitor your credit. And you can do so by annualcreditreport.com. This is a website that's been established by the federal government here, which is giving you access to all 3 credit bureaus. That's Equifax, Experian, and TransUnion. You can go on here, you can do an audit of all your personal information, understand what the banks and credit unions are seeing when you apply for a loan. There's a lot of information on your credit report, all your personal information, all your addresses that you've lived in the last 7 years. This is basically a risk report that the financial institutions are using when they're reviewing you for a loan application. Your credit is basically determining the interest rate that you're being charged on that loan, and your income is qualifying you on that amount. So really important that you're continuing to build and strengthen your credit over time. And when we're looking at some of that debt, we want to make sure that we're keeping it in its categories off the bat, and we're not just adjusting these, because you'll have special interest rates for special types of debt. So in regards to a student loan, if you're looking to refinance your student loans, consolidate them all to one, you want to keep that in a student loan refinance product. You still get the great low rates of student loans in a refinance product. You wouldn't want to just refinance that into a personal loan. That's going to have a much different interest rate. When you're looking to refinance your car loan, you want to keep that in a car loan, itself. You don't want to have that in a personal loan, because you want to take advantage of the security of those rates with a vehicle. Most importantly here, a lot of people are keeping debt on credit cards, and we're going to go into that in a slide in just a minute. But you don't want to be holding debt on your credit card. You can move that over to a debt consolidation loan and start paying, anywhere between 10% plus in interest, whereas your credit cards can easily be charging you anywhere between, 18 to 30% in interest. I've met a lot of people over the last little while, putting debt on their credit cards, thinking that they can, simply in a month, 2 months pay that off, but they just can't get that done in regards to their budgeting. So it's best to get that debt off in regards to a debt consolidation loan, providing you a fixed term and interest rate and a payment, so that you have a monthly plan in order to eliminate and pay that debt off. And most importantly, when you're looking at debt, you kind of have 2 abilities down the road. If you really start to get underwater, that's a debt management plan or bankruptcy. You really want to avoid bankruptcy as much as you can. That is kind of the last choice, but a lot of people don't realize there's debt management plans and that step before bankruptcy. So if you do feel that you're getting underwater, you do want to contact basically a debt management plan. They will work with you and your creditors to determine a payment solution compared to declaring bankruptcy, because you don't want to do that. That's the last straw that you have, basically, because that is something that will follow you around. It is noted on your credit report to 7 years. That will cause you some difficulty in regards to looking to receive financing in regards to any loan applications down the road, because once you've declared bankruptcy, you're basically writing off those debts. So doing a debt management plan will put you in a much better situation here, because you're working with those creditors to provide some payment compared to no payment there. So in regards to debt management here, really important, and I have the QR code on the slide here, annualcreditreport.com. Utilize that. You can go in every year, pull your credit report, and have access to it completely fee-free. Once you do it the first time and you pull all 3 credit reports, I really want to focus on the next steps the next year. Pull them every quarter. Take advantage of basically being in control of your credit report and your own personal information here. Here you can look to avoid any basically information that's got out there and has been exposed by different fraud schemes out there, because typically most people aren't even aware of it, I should say, until they approach a bank for, say, a car loan or a credit card, because those are the most frequently types of loans that are applied for, and they have no idea that they've been a victim of financial fraud. So having access to your credit report here is extremely important, so you can look, has your credit been pulled without your knowledge? Was a credit facility opened without your knowledge? Here, by monitoring your credit report through annualcredit.com, you can basically be in the driver's seat and manage your own personal information. Next, I want to talk about credit cards, because this is basically probably the item that gets us into debt the most. Basically, key items to consider here right off the bat is our APR. That's your annual percentage rate here. Typical annual rates on credit cards are about 23%. They typically have a range from about 15 all the way up to 30%. Really take note, what's your credit card offering you in regards to its interest rate, and what are the options out there in the marketplace? Credit cards give us a great incentive in regards to reward points, cashback, merchandise, airline rewards, but those are all incentives to spend. They're not providing you any incentives to save. So we really want to take note of that, where the money is going on a credit card. So we want to take note, is there an annual fee at all? Is it completely fee-free, or is there a fee anywhere between $100 or more than? Really important of noting, is there foreign transaction fees on that card? Some have them, some don't. This is a great item to know when traveling. And then as well, be aware of what those travel and reward incentives are, but don't make that the deciding feature of the credit card that you're going with. The first item should be, what's the interest rate on that card? Really important with credit cards here in regards to building and keeping our credit strong over time is monitoring our credit limit utilization here. This is one of probably the most, well, it's the second most important bucket in regards to our credit here. We want to make sure that we're not exceeding up to 30% when your statement is produced on a monthly basis for your credit card. And most importantly, you want to take note that your credit card is being used and has an outstanding balance when it's reported on your credit card statement, because that credit card statement is basically being reported to the credit bureau. So once you get your statement and you see what your credit limit is, let's say it's $1,000, you see what your outstanding balance is. Say this month you spent $500 on it. Well, that $500 is being reported to the credit bureau. That's noting a 50% utilization. So really what you want to strive for, as an example, your credit limit is $1,000. When your statement's produced, you want it showing approximately 30%, being $300 on your monthly statement. That's going to really show the credit report as well as your credit activity, that you're kind of managing your credit responsibly. You're not heavily reliant on credit, because the key when we're looking at your credit report as a risk management tool in regards to lending you money, setting that interest rate, is if we take your credit card away, can you continue to survive? Are you dependent on that credit? Do you actually have cash in your account? So really important, take note of when you receive your credit card statement, focus on having that outstanding balance within that 30% utilization limit, and that will be very key. Most importantly, we're making sure that we're making our payment. You know, credit card companies want to be our friend and say, you know what, you have this large amount of debt on that credit card, but you don't need to make that payment in full. We'll provide you a minimum payment requirement. Well, I appreciate they're trying to do us a favor here, but in effect, in providing us that minimum payment, they're really making quite a bit of money in interest here. And just basically our payment calculations here of looking at a $2,000 credit card debt at an annual rate of 23%, which I think is quite high of an interest rate on a credit card. You can find cards out there in the marketplace with 15, 18% there. No, the credit card company is saying, you know what, in regards to that debt of $2,000, you just need to make a minimum payment of $40. Well, as we can see, $40 is going to take us over 10 years to pay that debt off. And in effect, we're paying a total cost over the actual debt in regards to the interest rate charge there. So really want to take note, if we have to pay the minimum payment there, we can't make our full payment. We want to try to make as much as we can and increase that minimum payment. Just as an example in our chart here, increasing that by $15 or $55 is going to dramatically reduce that length of time, and most importantly, dramatically reduce the total amount of interest that we're paying on that debt. But most importantly, I wouldn't allow a situation to continue to be paying a high amount of debt on a credit card for a period of time longer than basically, a couple months here. I would look to a debt consolidation loan to move that debt off of a credit card directly into a loan where you have a fixed term, much lower interest rates, starting typically for best rates, it's around 10.5%. So getting away from that high interest rate on that credit card, most importantly, having a fixed monthly payment and having that term to know that you have a plan to pay that debt off. So really important in regards to that. Also, another key factor here is if we're not utilizing any credit cards, we want to make sure that we're not closing them. We want to make sure that we're continuing that credit card history, because that's what's reporting to the credit card agencies there. And having those cards open is really important. It's showing that length of transaction history. If you close a card, you wipe out that transaction history. And basically wanted to end on a note here with regards to understanding our credit and those key important buckets that we have here. As we've noted, payment history is so important. That's 35% of your credit. That's making your payments on time. We have 30% based on our utilization, and then 3 other buckets as we're continuing our journey through life here. We're bringing on additional length of credit history as we move forward. We're bringing on different types of credit in regards to installment credit and variable credit based on what the amounts we're owing, and then bringing on new credit over time. So with that, just want to thank everybody for attending our presentation today on budgeting and credit. We have some feedback here that you can fill out, and we'll take some questions from our audience and online here.
Great, thank you so much. We have a lot of questions. I want to get to the questions, but in the meantime, as you're waiting, if you could fill out our evaluation form, that would be great. Let us know what topics you want to hear for the future, and then a message about those that are collecting points for Vitality. All right, first question, Ryan. For the 50-30-20 plan percentages, is that gross or net income?
Great question there. That is based on net income. So that's after our deductions, and we want to focus basically our net income within the 50, 30, and 20 rule there. Fantastic question. Thank you.
Okay, how do you determine between traditional versus Roth? And what types of situations would one be beneficial than the other?
Yeah, that's a great question. And unfortunately, I'm going to kind of give you a general answer to that one because it's really going to focus your own specific criteria there. And kind of what you want to do is sit down with probably your financial advisor and accountant and take note of what's going to be the best strategy for you in regards to utilizing that, and most importantly, what those tax benefits are in regards to the tax benefit up front or the tax benefit at the end there. So that one you really want to focus with a specialist and advisor on to make sure that you're utilizing the best one available for yourself.
Is there a disadvantage to getting a debt consolidation loan versus transferring debt to a credit card with a lower interest rate?
Great question there, yeah. So, just transferring debt onto credit cards via balance transfers can be a good tool, but by all means, it's a short-term solution because typically a balance transfer on a credit card is only going to give you a promotional low interest period for a couple of months, maybe 6 months, maybe under a year. It fully doesn't give you a full plan to get out of that debt. At the end of the day, you're still going to likely probably have some debt left over. And in that point, you're better off in a debt consolidation loan because you're taking advantage of a full term in regards to knowing and having an action plan there. So while balance transfers can be great, can provide you some introductory low interest rates there, it's kind of a short-term solution. So you really want to be focused kind of on having, what is your plan to pay off that entire amount, and that may be in a better situation of moving to a debt consolidation loan so that you have a term and a fixed monthly payment and that full plan to get you out of debt.
I thought you could only get the free credit reports once per year. Is there a charge for checking them quarterly as you suggested?
Perfect. So you have access through annual credit report once per year for each individual credit bureau. So the first time I recommend pulling all three at once, and then after that going on every year, do one a quarter. And then basically you're set up for you're kind of monitoring all three credit bureaus, Equifax, TransUnion, and Experian.
Is there a drawback for paying credit cards in full for every billing cycle? For example, is it better to leave the balance?
Yes, great question. Actually, we were speaking about this before our presentation started here. Really important to show when you're utilizing your credit cards that you have a balance on that statement. If you're paying your balance off in full before your statement is generated, your statement is showing that you have no outstanding balance on your credit card. And basically a zero is being reported to the credit bureaus. Well, a zero being reported is basically showing that you're not utilizing your credit. There's no activity in there. So if you are, wanting to pay your credit card in full before the statement's produced, you can do so. But your best situation is at least to leave a balance of at least 30% on there and then pay it after. That's going to allow basically your outstanding balance of approximately 30% to be shown on your credit card statement, which is being reported to the credit bureaus, which is noting your utilization and most importantly, a good behavior in regards to that utilization and you're not being dependent on credit. That's a great question. Thanks, Julie.
Okay, can you suggest some debt consolidation companies and what's the difference between debt consolidation and debt management plan?
Yeah, so basically your debt consolidation is really your own focus in regards to your debt, working with basically a bank or a credit union and just moving that debt into a debt consolidation loan. You're still able to make the payments in full there compared to a debt management plan is you've really gone underwater here. You can't make that payment on a monthly basis. And you want to contact that institution, let them know right away that you're, in trouble. Typically, those institutions will work with you so that you're not receiving a 30-day late payment. But if you become, so much underwater in which you can't, then you want to work with a debt management plan there. And those basically advisors will help you work with your creditors to determine, amounts owed compared to that full amount there.
Some of my old credit cards expired and I didn't renew them. Is that the same thing as closing a card?
Yes, yeah, you definitely want to check with your financial institution there because they may have just closed those cards, possibly for your own benefit because they weren't being utilized. But in those being closed, that is removing your transaction history that you have built over time. And that's the most important thing that we're building, on our credit report is just a longevity of transaction history. And that's what it's all about. So if those cards are closed, you probably may have seen a reduction in your credit score because of the dropping of that transaction history. So if you have cards that you aren't utilizing, make sure you put a couple purchases on them, over a quarter. Once again, allowing that statement to come in, paying it. So it's reporting that outstanding balance to the credit agencies.
Okay, we'll do maybe one or two more questions in the interest of time. Are there debt consolidation loan centers you recommend? I'm afraid of getting scammed.
Oh, great question. So specifically here at the USC Credit Union, we have some great partners that work with us in the credit union space here, and specifically the non-for-profit space. Our partner is GreenPath Financial, and we have those resources directly online in our financial wellness section here. Those are completely fee-free accessible to all USC faculty and staff through the USC Credit Union for you, and they can work with you in regards to, reviewing basically the debt that you're in and working with you in regards to a debt management plan for your creditors. So great resource available for everybody, and that's directly on the USC Credit Union's website.
Great, thank you so much, Ryan. We did not get to a few other questions. What we'll do is we'll have Ryan review them afterwards, and we'll send it out in the post-communication email along with the slides and the link to the recording. In the interest of time, we want to just be mindful of your time. So with that, thank you so much, Ryan, for being here. And thank you everyone for attending our financial wellness seminar. We will have future sessions for you from this subcommittee. So thank you so much. Thanks, everyone. If there's more questions, feel free to put them in the chat. We'll get them answered. Thanks for being here on Zoom and in person.